I'd say that for me, one of the important things is people have been talking about a recession, and we still don't know really what a recession means, how we exactly define it. People have been talking about a recession since we got out of COVID. And my best guess is this being the 4th year of a presidential term, we typically don't have recessions. That goes to the next person's term. So I would say that more likely we slow down this year. Federal Reserve cuts interest rates. I think it's a bit aggressive. The Fed says they'll cut rates 3 times this year. The market says 5 or maybe even 6 times. Seems a bit much given that we just had the GDP figure today for Q4. The economy's got some good momentum. Another quarter of above trend growth. So I'm concerned about the longer term outlook for the US. We had a 6.5% budget deficit last year. It looks like it's about 6% this year, which is why we can grow faster than most of our competitors, most of our rivals. But I think that the recession, unlikely this year, more likely next year.
Thank you. Cameron?
Ditto. So we just released our outlook, I believe it was last week, and we titled it Stranger in a Strange Landing, which is in reference to the Robert Heinlein book, Stranger in a Strange Land, but talking about this idea that probably not a hard landing, probably maybe not a soft landing or a no landing, but more like a strange landing. And what we mean by that is that there really is no historical precedent for our current setup, given all of the distortions that happened during the pandemic. Something that is often written off, but still is eye-popping, is things like leading economic indicators flashing recession signals all of last year. Meanwhile, all of last year, we grew significantly above trend. And so you have all of these distortions that are continuing to have data make it be conflicting, meaning that you can look at parts of the labor market and say, all good, and then you can look at other parts of the labor market and say, oh, there's trouble brewing here. So what we think is that in agreement that we're not going to have a recession in 2024, but that we have to be extremely vigilant for changes in data which could happen rather quickly. That translates to an equity market that we don't think is going to trend, but will be in a very wide range. And what that means is that you have to be responsive, you have to be vigilant in not chasing things, but also be prepared to be opportunistic in the event that you do see softer markets. And we're also in agreement that the pricing of the Fed's 6 rate cuts is too aggressive, given the fact that it would be the largest non-recessionary rate cutting cycle since the early 80s, at the same time that you're running such large budget deficits. Typically, you don't see that combination outside of some kind of crisis, which it's hard to imagine that we're in right now, given 3.3% GDP last quarter.
Thank you. Lisa?
So I think I would definitely agree with what's already been said, and I'd expound on what Cameron said in particular, in how while lots of people are calling for a quote-unquote soft landing, very few people are actually articulating precisely what they think that means. Very specifically, there's one scenario that says a soft landing is going to be lower real growth, lower inflation, and somehow coasting, if you will, to a U.S. economy that is growing slightly below its potential. And that this will be, a gentle, thing that ultimately results in a reacceleration in 2025. We're not so sure about that. And I think, as Cameron said, there's many more dynamics going on here. And one of the most fundamental is to recognize that what was so unique about this cycle is we saw an economy that by and large was interest rate insensitive on the way up, right? We have very rarely seen in the post-World War II era a time when the Fed raised rates by 550 basis points in a 16-month time window, and nominal GDP kind of remained at 2 times normal rates, which is kind of where we are. And so one of the things we think we have to pay attention to is the extent to which people are getting over-enthusiastic about the extent to which the economy will be interest rate sensitive on the way down. Meaning, if in fact the Fed cuts rates, and we're in the camp, as my fellow panelists are, that we're probably closer to 3 than to the 6 that the market is pricing, that in fact you may not get much of a bump. Yes, are there certain sectors of the economy, housing, perhaps, some of the small cap, small company areas that have been particularly hit by higher interest rates? Could they see relief? Yes, certainly. But is that going to be enough for the rising tide to lift all the boats? Or do we actually fade into a soft landing that's kind of this stagnation-ish stuff that feels very meh after, nominal growth that has been kind of frothy? So translating that, as Cameron did, into a market call, we're also in a very similar place that suggests to us that U.S. stock markets are probably ahead of themselves, that we are probably going to see range-bound trading here, that the profit forecast for companies to produce 10% bottom line earnings growth off an economy whose nominal growth is maybe only 3 or 4% this year as opposed to 5, 6, or 7, might be a bit of a stretch unless unemployment really does start to tick up. So kind of a grind kind of year, solid, healthy for the economy, but our best guess is maybe a little bit meh for the markets, where stocks are kind of up 6 to 7%, investment grade returns, investment grade credit, bond returns are about 6 to 7%, and cash is kind of giving you 4 or 5. So not a lot to really inflame animal spirits.
Well, these are all great comments. I would just add, if you go back to the beginning of last year and you looked at our forecast for the U.S., we thought the U.S. would fall into recession around the middle of the year, and we spent virtually all of last year marking up that forecast. And actually, even the GDP print that came out this week was significantly above our forecast, even taking into account the momentum we'd seen earlier in the year. So when you add it all up, we missed GDP growth in the US last year by something like 2 percentage points. Now you could say some economists are too pessimistic. What we've effectively done is, as we've missed that forecast, we've just shifted the weakness out into later quarters. So officially, we still have a recession happening later this year. And I do see some signs of weakness within the economic data that make me think one is possible. One would be, I think, as these interest rates remain high, more households and businesses are going to be rolled into these higher interest rates. And we have seen globally that economies that had a faster pass-through of those interest rates, like Sweden, the UK, performed a lot weaker in the last few years. So that's one thing for concern. Another area is that credit conditions have tightened significantly, and those are probably going to continue to play through. And then the third area is that even though we have a very strong consumer, and that's been what's powered growth for the last year, you are starting to see some signs of softness if you look distributionally at lower income consumers. You've seen a tick up in subprime delinquencies, you've seen a rise in credit card debt, a few other factors that are concerning. That being said, I have to admit, even though we've shifted that out as part of our forecast, I'm very torn between that and something like a soft landing, and pretty much close to a coin flip on it. And I know a rule of thumb that a lot of economists at the Fed followed when I was there is if you have a forecast and 1 month goes against it, you ignore it. And if 2 months go against it, you think hard about it. And if 3 months go against it, you change your forecast. And, we've had 6 months of extremely impressive growth, and core PCE inflation has been running near or a bit below the Fed's target over that period, with very little major cost to the economy. So history tells me, if you look at every episode where inflation got as high as it did in this cycle, wage growth got as high as it did, and the labor market got as tight as it did, we identified 5 episodes where that's happened since 1965. All 5 of them have had a recession. All 5 of them saw significant loosening in the labor market. But as mentioned earlier, this has been a very strange cycle where you've had a lot of distortions to supply and demand. And maybe this cycle is different because we're seeing, as those shocks kind of work themselves out, inflation can just fall on its own. We've seen some of that in the labor market, where wage growth is still too high to be consistent with the Fed's target, but it's come a long way down from its cycle highs as labor supply has improved and labor demand has cooled a bit. So I have to say we've held on to a recession call. We're probably on the more bearish side of forecasters, but the data are telling me things are looking pretty good, and especially if the Fed's able to start cutting rates soon, that's going to help support the economy as well. So I'm pretty torn, even though our official case is a recession.
Well, thank you, Rob, and I'm very impressed by the convergence of views on this panel.
That's scary.
So at Davos this year, Steve Schwartzman said, and I quote, "Generative AI is core curriculum and no longer an elective course. If you're not the first mover, you're going to lose market share." End of quote. My understanding is that the market cap for listed companies has increased by $6 trillion due to AI. Is the panel concerned about an AI bubble?
Yeah, to tell you the truth, I mean, I think I use AI almost every day. I think it's really been an evolution. Remember, we used to have a spell check on Word documents. And then it evolved to, it tells, I think a Grammarly now tells you the mood or the tone. It prompts you for like suggestion, it gives you suggestions, word choices. And now you can put some of these things through AI, and it gets it like cleans it up, and edits it and writes it sometimes. And so I think it's an evolution, but I agree that AI is a big thing. I sort of think of it as maybe on par with the advent of the cell phone, the mobile phone. That's how dramatic I think our lives and our work lives are going to change. Whether it's a bubble or not, I kind of think this is the way the markets work. You get a new idea and people rush into it, like pet.com. We rush into these things, and it's sort of like maybe the way I cook pasta. I'm told if you throw it against the wall and it sticks, it's done. So sometimes you got to throw a lot of stuff against the wall before it sticks, and I think this is the way our market system works.
Maybe I could follow up, Mark, and ask you whether there are particular sectors that you think AI is going to benefit from, like for example, healthcare.
Yeah, I just think almost every profession I can think of where we use with data intensive, lawyers looking for case studies, medicine. I see this. Some of the things that AI is able to do already is adding new materials. One of the challenges I think industry has is that Moore's law is reaching an endpoint because the electrons can bleed over to the other side. Mm-hmm. And I think that AI is coming up with new materials that we'll be able to use to help extend that process. So I don't know. I mean, it's really beyond me which sectors or where it could be applied. I just see it applying every place. I don't know anybody who has tried it who hasn't found a purpose for it. Like, what's the purpose of it? I think we have to define for ourselves at still that stage. So I don't really know what's overvalued or undervalued. I just think it's an exciting time to watch this evolve.
Dawson, do you agree?
Compared to prior bubble valuations, we're not there yet. So there are real earnings as well. I think we do have to draw a line, and probably getting back to this whole point of we overestimate in the short term, underestimate in the long term. But if we're looking at earnings estimates, one of the most interesting things is the direct beneficiaries of AI. So NVIDIA, for example, who makes the chips that powers the software, has seen its earnings estimates go up by 3x over the last year because analysts completely missed it. They're usually the last to know. But what's interesting is that Microsoft, who has articulated an AI strategy with its co-pilots and everything, has only seen its earnings estimates go up by 8%. Now, obviously, Microsoft is a big behemoth and a huge ship, so even a big, exciting growth area may be a drop in the bucket, but I think it's important to remember that eventually you do have to see earnings materialize. And so a name like Microsoft is trading at its 2021 peak valuation. We would think for 24 returns, for them to be anywhere close to being as good as they were in 2023, you have to see the earnings materialize. I don't know if it's going to be to the extent like we had in 2023, but I would you take a hard look at where earnings estimates are going. Clearly there's a benefit to those with direct benefit, but we're not seeing it broadly yet.
I guess the perspective that I would offer really has to do with making an analogy to the internet, right? We believe that generative AI is going to be transformative. It is a profound, enterprise transforming technology. But like the internet, it is probably going to take us years to figure out who the winners and losers are. And so right now, the market has become very obsessed, as it did during the tech bubble, so I'm probably a little bit more in bubble camp, around valuing those who build the infrastructure to deploy the technology, right? So if those of you who may have been around in markets in 1999, 2000, you might remember the craze around stocks like JDS Uniphase and Tyco Undersea Cables and Corning Glassworks. These were companies, you haven't heard of them today, but at the time, they were instrumental or viewed as instrumental in building out the pipes of the internet. And right now, we're building out the pipes of generative AI. And that includes the computational power to process large language models. That means sophisticated chips, like the things that NVIDIA makes. And our best guess is that proactive investors are thinking out the value chain. They're thinking out over time. And they're going from a place where in 2023, investors were obsessed, right? Who are the AI enablers, right? Who are making the stuff, to who are the AI adopters, right? And I think this gets back to your original question, which is what industries, what sectors is this going to transform? And I think on that part of the question, it remains to be seen who the winners of generative AI are, right? Because the winners of the internet were not the equipment makers. The winners of the internet were Amazon and Google, who at the peak of the market in 2000 had valuations that were, Google was not public, okay, and Amazon was basically a $1 stock having, IPO'd at $5, with investors saying, so their whole entire business models are going to put Borders bookstore out of business? Huh? Things change.
Rob?
I think everyone here knows a lot more about stock valuations than I do. But I'll talk a little bit, I think, about the economic side, which I've been very surprised the number of questions that I get from investors if AI is boosting productivity growth now. Given, and markets are supposed to be more forward-looking and think about what the changes are going to be over decades. But I struggle to find a good argument that productivity growth has been boosted last year, let's say, because of AI. I do think that it's going to be a positive development. Some of the estimates I've seen that you could get something like 1/4 to 1/2 on productivity growth per year. Something in that range sounds reasonable, but I think it's going to take time, and it's not a 2023 or 2024 story. The other element I would highlight, maybe two more, is one, I think whenever you have these large technological changes, it's not just the markets or the economy. There's going to be probably an entire regulatory structure that gets put around this technology. And when Congress and regulators get involved, that's probably going to be a long process in itself. But ultimately, that's probably part of what has to happen with the process. The second I would highlight is we get a lot of questions about job displacement. And I think the history of large technological changes is pretty consistent in that you get jobs that disappear. There are plenty of jobs like in our industry that don't exist anymore due to technological change. But on net, you usually end up with a positive gain in jobs from these changes. So I would be kind of bullish on net on job creation and bullish on productivity, but I think it's a longer term story.
I'd like to just follow up on that point you just made, Rob, because in recent years, it seems as though the Magnificent Seven have been on a job hiring spree, and they're hoarding employees. I think they added like 500,000 employees. Do you see a period now of a reduction in force, and will that have major dislocations?
Yeah, and it's a great question. I think the term that you hit on, labor hoarding, is really key for this cycle, because there's been sort of a puzzle where, even for these large tech companies where you saw a lot of layoffs, as interest rates were rising. On net, you really didn't see much of it in the economy. Even in the information sector, you saw relatively mild contraction in overall employment, and that's from the place that was correcting the most. But if you look even beyond technology, if you look at the construction industry, the housing market was correcting pretty substantially when interest rates first went up, and construction hiring was still growing at a rapid clip, which tells me, and if you look at the U.S. JOLTS data, which tell you about labor market flows, they tell you that layoffs have been historically low throughout this cycle. And it's not just in the U.S. If you look in Europe, you've seen growth slow down pretty significantly, but labor markets remain relatively tight. So I do think even just beyond these technology companies, we are in a period where firms looked at this cycle and they saw how hard it was to hire workers. And even as growth slows down, maybe more hesitant to lay them off, especially if they think that the slowdown will be relatively mild. So I do think you're in a period where on net, the technology sector probably continues to expand in hiring as we got past the worst of it with the interest rate hike. But more generally, I don't expect, even as growth slows in these economies this year, if our forecast is right, I don't expect huge job losses, at least from a historical perspective, because this labor hoarding is going in the other direction.
I'd like to return to equity markets. We've just hit an all-time high. The conventional wisdom would be that you don't invest at the top of the market, right? Is there enough momentum and liquidity to drive equity markets higher?
Do you want to take that?
Are we looking at me? Okay. You had a lot of really important keywords there, momentum and liquidity, to start there. Momentum is a short-term driver and a short-term phenomenon. This market has momentum. We saw what was a buyer's thrust the end of December, at the beginning of December, that had a spike in what's called the 20-day highs, where you saw effectively people clamoring to get into the market. Typically, that is followed by powerful 6 and 12-month forward returns. And after a corrective period, once you hit an all-time high, typically that is also followed by above-average returns. Now, if we look at the driver of the returns over the course of 2023, it had nothing to do with earnings. Earnings estimates for 23, 24, and 2025 were stagnant throughout the entire year, which meant that as the narrative shifted from hard landing to soft landing, to no landing, to banking crisis, to AI revolution, earnings estimates didn't change. And actually, over the last couple of months, we've seen earnings estimates get cut for 24 and 2025, just slightly, but enough to keep your eye on, which means that all of the upside in markets has been driven by valuation expansion. And valuations are now trading at 20.1 times forward earnings. That is very expensive on a historical basis. We've only traded above this level 2 different times over the last 40 years. The tech bubble and the COVID policy bubble. When interest rates were 0, we were growing money supply at 30%, and the balance sheet was expanding by $5 trillion. A very good environment for valuations. So we're in pretty rarefied air when it comes to valuations. It's just good to remember that valuations are not a good timing tool in the short run. They can go high and they can stay high. It's because that's how bubbles exist. But they're a very good tool in the 2 to 5 year forward, meaning the higher valuation you press, the more likely we're going to have poor forward returns over the medium term. So that's where the discipline comes in, but realizing that there is momentum in the short run, so you kind of have to let your winners ride, but be very prudent.
Yeah, maybe I can just jump in quickly.
Yeah.
Primarily, I'm a currency strategist. I follow the foreign exchange market. And one thing that I think is important here is that the U.S. dollar, by the OECD has a measure of valuation, and they have the euro and the yen about 50% undervalued. So that means that your dollars, can buy more value, more assets in Japan and in Europe than they can in the U.S. And we already saw this last year. Warren Buffett began buying Japanese stocks.
Yep.
Japanese stocks, I don't know where they are right now. They're opening today right now, but they're trading their 36-year highs. And the reason they're trading their 36-year highs is because it's been undervalued for so long. We're at record highs. But it is, I think, the fifth day in a row of record highs for the S&P 500. We've had to wait a generation to get to these levels in Japan. And Europe is the laggard, of course. They're going to have their GDP next week, and it looks like they'll be lucky if ECB President Lagarde was right. She said stagnation. The market's looking for a small contraction. It'll be the second quarter in a row. So there's good reason why some stock markets are underperforming. But I think our dollars, what we should be doing, I think, generally, is we as Americans have a lot of money in U.S. stocks. We're exposed to the U.S. stock market in many ways. This is the time to be diversifying, where they're looking for value, but overseas has some interesting opportunities for us dollar-based investors.
Fantastic. So I want to pick up on your question about liquidity, because I think that this is really important. So there were many upside surprises last year, whether it was growth, whether it was fiscal spending, but one of the more provocative ones was the extent to which liquidity was ample. And certainly within the banking system, while we saw some tightening, within the central banks, within the global currency markets, within the backdrop of excess savings on household balance sheets and at corporates, we were able to kind of pull off what I've called the perfect dance, right? Which was last year we were able to absorb $1.1 trillion of US Treasury issuance from running deficits, right? Against the back while interest rates were rising at 550 basis points and the market went up 25%. If I were to write that on a blackboard and say, this is what happened, everyone would say, no, it can't, the math doesn't work. But that is what happened. Our best guess, as we look at the system coming into 2024, is we're finally starting to normalize. That 30% M2 growth that occurred back in 2020, 2021 is finally starting to be absorbed. And so when we look at excess bank reserves, they had been at 2.5 trillion, they're now at 700 billion. If we look at household savings, they had been as high as 2 trillion, they're now running at about 300 billion. Now, why is this really important? It's really important because this year, the United States Treasury is not going to be borrowing 1.1 trillion, they're going to be borrowing 1.8 trillion. And they're going to be doing it against a backdrop where the Fed, at least at the minute, is still doing quantitative tightening, which at $95 billion a month is another $1 trillion a year. So just the US government and the Fed balance sheet runoff is going to require $2 trillion of liquidity. Now, where is it going to come from? And that's where we're starting to have a hard time. And so, Cameron talked about the fact that last year was driven entirely by stock valuation multiples. This is really important. It wasn't driven by earnings. And so what may in fact happen, right, is the liquidity that drove those valuations upward, right, begins to come out because the interest rates that will be demanded, right, to finance Janet Yellen's issuance, right, stay high. And if I can get 4, 5, 6, 7% returns, I may not need to be in stocks, especially at these valuations. So we're concerned that liquidity becomes an issue. We're concerned, and I don't know if we're going to get there, that debt sustainability, deficit financing, deficit spending does need to become an issue in our presidential debates. And we are in the camp that says we certainly hope that it does because we think it's really important because this is a market that I think after 15 years of financial repression has been lulled into a sense of security that when the Fed starts cutting rates, they'll be able to cut to a neutral rate that's somewhere sub 2%. Our best guess is we may be in a new world, and that new world may mean that you can only cut to 3 or 3.5. And if that's the case, 20 times forward valuations or 35 or 58 for some of these semiconductor companies makes no sense.
I can't resist, Lisa, following up and asking you if you were the architect for our fiscal policy where would you be focused, and do you foresee higher taxes?
So I don't know if you have to finance our deficits through higher taxes per se, or you need to finance the deficits through some kind of reform around entitlements. Some kind of reform around entitlements. And I know that this is, also, will become a political issue. But when you think about the size of the pie and the portion of total receipts and budgets that are going to be consumed by Social Security benefits and Medicare benefits in the year ahead, as people live longer, healthier lives, and quite frankly, as boomers and Xers and soon millennials end up working well into their 70s, I think as a society, we're going to have to ask ourselves the question, is this about taxing people, or is this about reforming entitlements structurally?
Could I add something on the liquidity and deficit side? Because Lisa's points are so very important, because that perfect dance by Yellen, the way that she pirouetted around it is that she used more bills instead of coupon bonds. And effectively what that did is it allowed money markets to be able to absorb that bill issuance instead of coupon bonds, which would have effectively taken liquidity out of the system. But what's interesting is that the guidance for SIFMA is about 20% of the budget can be bills. They're now at 22%. So can she pirouette again in 2024 and rely on the bills as much as she had? It's one of the reasons why you have such a bigger deficit need to fund this year is because of how much short-term paper that she used. So in the context of everybody thinking that an easier Fed plus an end of QT is great for markets, we're calling it the liquidity dark horse, because maybe the liquidity is less important from the Fed, more important about what the Treasury does, and that could absorb liquidity from the system, put downward pressure on valuations, mostly for growth stock valuations, which are very correlated to liquidity, and that could be the thing that catches people flat-footed, because if you look at positioning and flows of funds, it's all gone into growth and tech, which of course has the narrative associated with AI. So that's where we don't want to be complacent, because you could get caught very flat-footed.
Could I add a bit just on the fiscal situation? This is something we took 3 months of my life. We wrote this big report about this at the end of last year when markets were going a bit crazy over the summer about 10-year yields rising. People were concerned about government debt and deficits. And I think the first thing we looked at when looking at the report is deficits are set to be big for the foreseeable future, I think probably regardless of who ends up in power. If you look at the CBO's current projections, deficits are averaging something like 5.5% to 6% of GDP over the next decade. Debt to GDP over the next few years should surpass the World War II peak and then keep rising after that, whereas after World War II, there was a massive deleveraging. And if you compare that, if you look at the 5 years before COVID, deficits average something like 3.5% of GDP. So they're going to be big no matter what. And if you look, politicians don't have too much incentive to really cut deficits unless markets tell them they have to. If you look at estimates of the fiscal multiplier, so if you cut the deficit by 1% of GDP, on average, most estimates are somewhere around 1 for 1. So that would cost you about 1 percentage point in growth. So the cost is big. Politicians don't really want to do that. And then if you look at the deal space, I think it's interesting when Trump and the Republicans were in power, they cut taxes and boosted deficits. And when Biden and the Democrats were in power, they boosted spending and boosted deficits. And when they get together, they don't really want to talk about the two things, about tax reform and spending reform. So I think deficits are going to remain big and debt's going to rise. Now, in terms of how concerned to be, I think the markets, if they give them a signal that, all right, well, maybe who's going to absorb all of this Treasury debt? Maybe there's not as many buyers of it. That's when politicians will really start to pay attention. I have to say, I'm a little bit calm on this point because I remember we used to debate this when I was at the Treasury Department. They always debate, okay, well, who's going to buy Treasuries, especially if China stops buying or something. And you're seeing some of that now. You're not getting those big buyers like the Fed or China, but you've actually seen pretty strong foreign private demand for treasuries. So my conclusion from that work is, when you ask, are there going to be buyers for treasuries? There's always buyers for treasuries. And so maybe I'm too calm on that front, but I think for politicians, until they see severe market signals, they're probably going to keep spending.
I would just say I agree there's always buyers for treasuries. The question is, what's the price?
Yeah. So far, yeah.
I think that's my segue for my fixed income question. With yields at historic highs, is this a good time to return to the 60-40 asset allocation of yore?
I'll give it a shot. I think that probably not. I mean, even though as the population's getting older, it does seem to make sense that we adjust our portfolios. There's this rule of 7. You get 7% for 10 years, you double your money. So how can you do that? So here's a stock market calls, but I think that increasingly we have to lower our expected rates of return. And if we could get 5%, I think a few years ago we'd be happy with 5% with taking very little risk. Right now I think, and so as a foreign exchange person, I'm looking at other countries, and we're not the only ones that issue dollar-denominated bonds. Many countries issue dollar-denominated bonds. Many companies, foreign companies, issue dollar-denominated bonds. So you don't have to take foreign exchange risk. You can have sovereign risk in other countries issuing dollar bonds. And a country that might have dollar receivables, like an like oil revenues or commodity revenues, they have dollar receivables, they have a dollar bond, it's a good match. And so I would think about fixed income, adding that to our portfolios in a way that Americans typically don't. I think to your point, I think we are buying more treasuries, but generally this is really the first time we're really buying bonds. And I think that there's some room there in our portfolios. Whether we have to go 60-40 or not, I really think it's a question of your appetite for risk and your age.
I would just jump in and say, the classic 60-40 portfolio was really proposed and constructed under a regime and a set of assumptions that stocks and bonds were negatively correlated to one another, right? That if, stocks stopped going up because growth was flailing, that bonds would go up and ballast your portfolio. As Cameron pointed out, we're a little bit in this new era, right? Where, we have a very concentrated market. The top of the market, those top 10 stocks, which are about 35% of the market cap, are very expensive. They are essentially interest rate sensitive. And so we've gone in and out over the last, 3 or 4 quarters of this dynamic where stocks and bonds are very correlated to each other. And so the diversifying properties that they hold against each other may be changing. And that's where, I question the 60-40 portfolio. As you may have gleaned from my earlier comments, there's many parts of the fixed income market, cash, and certainly some investment grade credit that I'm happy to hold. The question is, what else can I own? Not just assuming that my stocks diversify any risk that I have.
We tactically think that yields are biased higher in the short run. We came into the year expecting that because of economic data that was not confirming what the bond market had priced in for the Fed's path. So better data than expected means Fed probably doesn't cut as much as what the bond market thought they would at the very end of 2023. But then you add on top of that the quarterly refunding that we get from the Treasury. A good date to remember, on the 31st, or is it the 29th? It's coming up. We get it's sometime next week, we get a refunding announcement from the Treasury. That was a key driver of volatility in yields, the thing that drove yields up to 5% and then brought them right back down to 4%. So what we would say is that if you think that you missed the opportunity to add duration to portfolios or lock in yields, you're likely going to get another bite at the apple. And think about it from a long-term perspective. I think a lot of people think about fixed income mostly on the long end of it being a tactical kind of trading opportunity and maximizing the return, but there are certain fixed income that now at yields you can actually effectively asset liability match and hold to maturity. And that's one of the things that we saw when yields bumped up to 5%, we saw credit spreads widen a little bit, that we were able to pick up some debt that was attractive in the assumption that we can tolerate near-term volatility and hold it to maturity to meet some of the liabilities in portfolios. But the question about risk tolerance is so very important because you have to think about liquidity. It cannot be decisions made in a vacuum. So it's your own version of 60-40, but we also add in alternatives, which is a whole different discussion.
Yeah.
I'd like to, I just feel that this would not be complete without bringing up crypto. And my understanding is that crypto does not have mass adoption and that only 6% of investors hold crypto. Will this change with ETFs invested directly in the token?
I have a problem with even thinking about crypto as money. I mean, I'm old enough to remember the moral majority. They weren't very moral, they weren't the majority. Right? And the same thing with crypto, they say they're money, but they have none of the attributes that we think of as money. Right? So one thing that economists would say is money is a means of exchange. My landlord is not going to take crypto. My grocer is not going to take crypto. Most importantly, the tax masters aren't going to take crypto.
Even the crypto conference doesn't take crypto.
Elon Musk is prepared to take crypto.
Yeah, so even with Elon
He's the
Musk-
third largest holder of crypto.
Yeah, so Musk says he'll sell Teslas for Bitcoins. You know how many he sold for Bitcoins? None. No one wants to part with the money. There's this economic law, Gersham's law, that basically is that bad money chases out good. What that means is that if you have crypto and you have a fiat currency, let's call it the dollar, and you want to pay for something, you say, well, this fiat money, central banks are printing it like it grows on trees. So I'm going to spend that. I'm going to hold on to what I think is going to be valuable, this scarce, this limited supply, crypto. So Bitcoins never get that networking effect to make it money. And also, there's a contradiction. That's what I think the contradiction at the very center of it. If you think it's going to be better than fiat, you're going to hold on to it. You're going to hoard it. And if you think that paper money, fiat money, is not going to be worth much, you're going to spend it. And that's exactly what's happening. Not only is the crypto held by a relatively small amount of people, but it's really, I think, ultimately just a speculative vehicle. This is another way for my understanding would be that the system has produced so much money. We think of one side of that ledger, we call it debt. But the Treasury's debt is my asset. It's my retirement money. And so I think the same thing with crypto. There's no bonds. It has no yield stream. It's just a speculative vehicle. Too much money is washing around the system. We find outlets for it. I kind of consider crypto like crypto does for savings, what trees do for carbon. Trees are a carbon suck. Bitcoin is a suck of capital that would otherwise be chasing overvalued stocks or overvalued bonds or some other real estate, some other market. So crypto is a safety valve. We don't think of it like that because we want to think of it as money and this hot thing. And I really think that it has no real economic function except siphoning away that savings so it's not used for more destructive purposes.
If you told me I could isolate two factors, liquidity and doomsday preppers, it's a great asset to be able to do that. It's a psychological commodity, at least Bitcoin is. And of course, there are foreign areas where it does have usefulness as a very volatile, in quotes, store of value. But you know, to us, it's kind of like airlines. Investing in airlines can be dangerous to your wealth. I get this idea that, put some in as this YOLO call option, but I think that the idea of it being the new future of the economy, to your point, which is really interestingly made, the adoption has been so low, and it's been around for, 15 years? ChatGPT, I think, has gotten faster adoption over the last 12 months, so it calls that into question.
I want to raise something that's been around for a long time, namely gold. The dollar has been sideways for the last 8 weeks. Is gold gaining on a weak dollar?
I often think about gold. I know that there's a lot of talk of central banks buying gold. China's been buying over, say, 200 tons of gold. But when you look at the value, like what that ton of gold is worth, China has over $3 trillion of reserves. The gold that's bought is hardly even 1% of the overall reserves. And so typically on most days, I think that if you know which way the dollar is going and which way interest rates are going, you have a good idea of which way gold is going. Typically it goes, like right now, I'd say that you've had a relatively firm dollar since the beginning of this year, and you've had interest rates rising, and so gold has gone no place. Typically, a weaker dollar, lower interest rates, good for gold.
Finally, I'd like to turn to real estate. How do you assess the commercial real estate overhang?
Could I can start, and I think it's interesting the number of shocks that we've had over the last few years in a lot of spaces that are kind of unknown. What the Bitcoin conversation made me think of is, speaking of low adoption, as interest rates were moving up, I mean, huge parts of that sector collapsed, and you'd be very hard pressed to find any economic fallout, aside from a market fallout in those crypto markets. And then, of course, when regional banks were collapsing last year, most of our questions we were getting was about commercial real estate, and so we spent a fair amount of time looking at exposures, talking with our commercial real estate analysts. We all kind of kept ending up at the same place, which so far feels like a pretty good conclusion, which was that there's going to be some type of correction in commercial real estate, but it's important to kind of recognize that commercial real estate's a very diversified asset class, and the real area of concern is in office space, and even within office space, those concerns are very concentrated. So everyone you talk to agrees in Manhattan there's going to be some type of long-term correction in office space. From what we've heard, there's still strong demand for sort of what's called A-level office space. So it's not that people don't want to go to offices, they want brand new offices. They don't want 40-year-old office buildings. So there's going to be kind of corrections within those spaces. I think those corrections are going to be very regionally concentrated. And the expectation is that it's a known issue that's going to happen over a long period of time. And if that's the case, the economic implications for the real side of the economy are fairly minimal. I think of it kind of akin to the sort of correction that happened in the mall space in the US, where there were a lot of malls that weren't as viable, happened over a long period of time. People still go to malls, but they go to the best malls. And I kind of have that analogy in the back of my head. But again, it's a risk. It's certainly a risk we were paying much more attention to and putting weight on when that regional banking crisis happened, because it is true that these regional banks are more exposed to that sector. But I think, again, the risks are probably pretty concentrated and probably will be pretty spread out over time.
And could I follow up on residential real estate? Do you see the new normal as unaffordable and undersupplied?
Well, it's interesting. We've talked a lot on this panel about things in this cycle that have really surprised us. And if you look at the sort of history of recessions, they kind of follow a sort of clockwork pattern where the same things usually start to happen in a similar order. And some of the earliest signals are the yield curve slope starts to go down and eventually inverts. But the other one is residential real estate starts to fall because it's a very interest rate sensitive sector. And then you saw that happen in this cycle, and everyone said, okay, well, look at the yield curve, look at the residential investment, there's going to be a recession. Then you had this weird pattern where things started to pick back up in the housing market. And I think what we've seen is we've got kind of this lock-in effect that's been specific, not just to the U.S., but especially in the U.S. where we have a lot of 30-year mortgages, where people have low mortgage rates, they don't want to move, so existing home supply is very low. That has pushed up existing home prices very high, and there's been a lot more new supply and new construction coming on, and those prices have actually been more contained than what we've seen on the existing side. I don't want to say that, and things are very unaffordable now if you look on net. I want to say that over time, I think the situation is going to be better, so I do think as interest rates fall, hopefully that's going to unlock a lot of pent-up existing home supply, and you are seeing still a massive amount of construction on the new home side, and there's a big backlog in new homes. So I do think as interest rates fall, hopefully affordability improves, both because interest rates are falling, but more supply is coming to the market. But right now, it's definitely a very tough environment for homeowners or people who want to buy homes.
With that, I think we've reached the end of our hour. Please join me in thanking this outstanding panel.